Welcome to the Phantom Trader world, where clarity comes before execution.
Today, we are stripping things down to the studs. We usually look at specific trends, complex events or the latest tech. But today, we're looking at something much more fundamental. We're going to tackle a topic that I think carries a massive amount of cultural baggage. When I say the word trading, what is the very first image that flashes into your mind?
For the vast majority of people, it's chaos.
Exactly. It's absolute chaos. I think most of us have this cinematic montage in our heads. We think of Wall Street, right?
Oh, yeah.
We think of guys in expensive suits, screaming into telephones, flashing red and green numbers, adrenaline, intricate charts that look like heart monitors, and money.
Lots of money. Fast money. That's always the key.
Right. Fortunes made or completely vaporized in a split second. It feels aggressive, it feels fast, and honestly, it feels completely inaccessible to a normal person. It kind of feels like a club you're not in.
That is the common perception. It's the Hollywood version of it. But here's the thing about that image. It is entirely superficial. If you immediately equate trading with money and financial markets, you are looking at the roof of the building and completely ignoring the foundation.
You're looking at the result, not the process.
Precisely. You're looking at the result. Money is just the surface metric. It's the scoreboard, not the game itself. So today, we are going to strip all of that away. We are doing a deep dive into a concept our sources call the architecture of probability.
The architecture of probability.
Yes. We're analyzing a framework that argues at its absolute core, trading isn't about finance at all.
Okay, that's a bold claim.
Yeah.
If it's not about finance, what on earth is it?
It's about decisions. Specifically, decisions made under uncertainty. Decisions made with limited information, but with very, very real consequences. The central argument we're exploring today is that if you misunderstand this core definition, if you think trading is just about picking winning stocks...
Which is what most people think.
It is. And if that's your starting point, then every strategy, every technical indicator, every bit of discipline you try to build on top of that is, well, it's doomed.
Because the foundation is broken from the start.
Exactly. It's the cost of a structural flaw. You can build a beautiful mansion on top, you can learn all the candlestick patterns, buy the fastest computer, subscribe to the best news feeds. But if the slab is cracked, gravity eventually wins. The whole house collapses.
Okay, I want to unpack this, because it sounds like we're veering into philosophy. But the source material really insists this is the most practical thing a person can learn. So if trading isn't just buying low and selling high on the New York Stock Exchange, how do we define it universally?
Well, to really understand trading, we have to go back, way back. Before the New York Stock Exchange, before crypto, before fiat currency or even gold coins existed, our sources point out that trading is a fundamental aspect of the human condition. It's really the anthropology of exchange.
So we're talking bartering. Hunter-gatherer stuff. I give you 3 chickens, you give me a goat.
That is the physical manifestation of it, yes. But let's look at the psychological mechanism underneath the chickens and the goats. At its simplest, pre-financial form, trading is defined as exchanging something you have right now, a certainty, for something you believe will be more valuable in the future.
Belief seems like the heavy lifter in that sentence.
It is the critical word. Think about the gap. You have item A right now. You possess it. It's real. It is tangible. You want item B, which is in the future. That gap between the now and the future, that is where the risk lives. That belief is based on expectation, not certainty. You are giving up a sure thing for a possibility.
When you frame it that way, it really sounds like we are all traders all the time. It's not just the guy in Wall Street.
We are. And that is the first key insight from our deep dive today. You listening to this right now, you are a trader. Even if you have never opened a brokerage account, even if you've never looked at a stock chart, you are executing trades every single day of your life.
I'm going to push back a little bit on that. It sounds good metaphorically, but does it actually hold up? Prove to me that I'm a trader when I'm just, going to work.
Let's look at your job. That's actually the perfect example. You wake up, you commute, you sit at your desk for 8 hours. What are you actually doing? You are trading your time. Time is a finite, non-renewable resource. You have it right now, and you are selling that asset to your employer.
Okay, I see that. I'm selling my hours for a salary. That's the trade.
But look at the structure of that trade. It's a trade based on expectation. You expect that the money you receive at the end of the month will be valuable enough to cover your needs. You expect the company will remain solvent long enough to pay you. You are trading a biological certainty, your time on this earth, for a conceptual security, which is purchasing power.
And there's risk there, for sure. The company could fold. Inflation could make the salary worth less than I thought.
Exactly. The trade isn't risk-free just because it feels routine. Or look at education. This is a massive trade millions of people make every year. You trade a significant amount of money in tuition and years of effort, again, assets you have now, for the expectation of higher earning power in the future.
And that's definitely a trade with risk. I mean, we all know people who made that trade, took on the debt, and, well, the future value didn't quite pan out. The degree didn't lead to the job.
That is a failed trade, a losing trade.
Yeah.
But it was still a trade. Or even simpler things, going to the gym. You trade comfort and energy now for health and longevity later. The point is, financial markets didn't invent these dynamics.
They just formalized them, put them on a screen.
They concentrated them, they accelerated the pace, and crucially, they made the outcomes measurable in real time.
Yeah.
In life, the trade of going to the gym might take 5 years to pay off visually. In the markets, you know if you are right or wrong, sometimes in a matter of minutes. But the underlying mechanism, that core of decision-making under uncertainty, it's identical.
This brings us to the mission statement of this deep dive. If we are all traders, and if the stakes are essentially how we manage our lives and our resources, what is the goal for us today? The source mentions moving from a mindset of gambling to one of structure.
That is the entire shift. The goal for you, for the listener today, is to move away from the desperate need for prediction, which is how amateurs operate, and toward an understanding of probability. We want to help you build clarity, because, as the source argues, clarity must always come before profitability.
I love that phrase, clarity before profitability. It implies most people try to do it completely backward.
Most people are trying to win the tournament without knowing how the knight moves on the chessboard. They want the profit, but they don't understand the game. They see the prize money, not the mechanics.
So let's talk about the scary part of this definition. You mentioned earlier that we trade what we have for what we expect will be valuable. But expectation implies that, well, it might not happen.
And that is the role of uncertainty. This is where the rubber really meets the road. Every single trade, whether it's buying Apple stock, choosing a career path, or even proposing marriage, has 3 distinct elements.
If it laid them on me.
Number 1, risk. You have to put something on the line. No risk, no trade. It's that simple. Number 2, potential reward. There has to be a reason you're doing it, a better future state. And number 3, an uncertain outcome.
And it's that third one that keeps us up at night, isn't it?
It is. Because we are, biologically wired to hate uncertainty. Our ancestors survived by knowing for sure that the rustling in the bushes was a tiger. Uncertainty was dangerous. It could mean death. But the expert trader, the professional decision maker, understands that in this arena, uncertainty is a feature, not a bug.
It's not something to be eliminated.
You can't eliminate it. The novice tries to remove the uncertainty. The professional learns to manage it.
This transitions perfectly into our next section. The myth of prediction. Because I think this is where most of us get stuck. When I think of a Wall Street guru or a market wizard, I think of someone with a crystal ball. I think of someone who knows what's going to happen next.
That's the beginner's trap.
Yeah. We look for the perfect entry. We look for that magic indicator that turns green when we should buy and red when we should sell. We want to know the future because, well, knowing the future feels safe.
It is human nature. We crave certainty because certainty calms anxiety. But the source is incredibly blunt about this. It's a hard truth, maybe the hardest truth, that you need to swallow if you want to understand this architecture of probability.
Give it to us straight.
No one knows the future. No one.
Okay, but hold on. No one is a big word. What about the big banks? Goldman Sachs, JP Morgan. They have armies of analysts.
They don't know. They have projections. They have incredibly sophisticated models, but they do not know.
What about the hedge fund managers with multiple math degrees from MIT?
They don't know.
What about the supercomputers? The high-frequency trading algorithms. Surely they know what's going to happen in the next millisecond.
Not even them. They can process data faster, they can react faster, milliseconds faster, but they cannot predict the future with certainty. They are dealing in probabilities, not prophecies. If anyone actually knew the future, there would be no market.
Explain that. Why would there be no market?
Think about it. If I knew with a 100% certainty that Apple stock was going to double in price tomorrow at 9:00 a.m., I would want to buy it, of course. But who would sell it to me?
Right. Nobody, if they also knew.
Exactly. If everyone knew, no one would take the other side of the trade. The market only exists because there is disagreement on value and fundamental uncertainty about the future.
This feels destabilizing. I mean, if nobody knows what's going to happen, isn't it all just gambling? If prediction is impossible, what is the job? Why are we even having this conversation?
That is the paradigm shift. The job is not prediction. The job is probability management.
Okay, probability management. That sounds impressive and sounds a little corporate, but what does it actually mean in practice? How is that different from just trying to be right all the time?
Well, when you try to be right, you are attaching your ego and your sense of safety to a specific outcome. You say to yourself, I think the stock will go up, and if it doesn't, I have failed. I am stupid. The market is rigged. You take it personally.
Right. And if I'm wrong, I lose money and I feel shame. I feel like I made a huge mistake.
Exactly. You personalize the variance. But if you are managing probability, you detach from that. You say, based on the evidence I have, this scenario has a 60% chance of happening and a 40% chance of failing. If it happens, I will make $300. If it fails, I will lose $100. Is that a good bet to take?
So you're not obsessing over whether the coin lands heads or tails on this specific flip. You're thinking about the long run, over hundreds of flips.
Precisely. Professionals do not obsess over being right on the current trade. They fully, completely accept that they will be wrong, often. In fact, they build their entire business model around the assumption that they will be wrong frequently.
This brings up a really counterintuitive point from the source that I want to highlight because it blew my mind a little. It says that many profitable traders, people who do this for a living, lose more trades than they win.
Yes. This is actually quite common. In fact, some of the best traders in history have win rates below 50%.
That breaks my brain a little bit. In school, if I get 40% of the answers right on a test, I fail. I get an F. My parents are mad. How can a trader be wrong 60% of the time and still be a professional, still make a living?
This is the mechanics of survival. And it's the difference between accuracy and expectancy.
Okay, walk us through the math of that, because I think listeners need to hear the numbers to actually believe it.
Okay, let's play a simple game, a coin toss. Every time you lose, every time you're wrong, you have to pay me $1.
Okay, manageable losses. I can handle losing $1.
But every time you win, every time you're right, I pay you $3.
Okay, I like those odds. So the payoff is 3 times the risk.
Right. Now, let's say we play 10 times, and you lose 6 of those times. You are wrong 60% of the time. You have paid me $6.
So I'm down $6. I'm losing the majority of the time. I'm just looking at my win-loss record. It looks pretty bad.
It looks terrible, but let's look at the account balance. You won 4 times, and for those 4 wins, I paid you $3 each. That's $12.
So I had 12, lost 6. I walked away with $6 profit.
Even though you lost more times than you won. You failed the test of accuracy. You got an F on prediction, but you got an A+ in profitability. This whole concept is the philosophy of asymmetry.
Asymmetry.
Yes. You want outcomes where the potential upside is significantly larger than the potential downside. Success in trading, and really in decision-making generally, is not about how often you are right. It is about how much you win when you are right versus how much you lose when you are wrong.
So the metric of success isn't being a fortune teller. It's about being a great risk manager.
It is about survival. You just need to survive the losing streaks, the times when you are inevitably wrong, so that you are still in the game when the winning streak comes.
The source uses a visualization here that I found really powerful to illustrate this. The tale of 2 traders. I want to set the scene for our listeners because this really drives home the difference between the amateur and the pro.
Yeah, let's do it. It's a great example.
Okay, imagine 2 traders. We'll call them Trader A and Trader B. They are looking at the exact same market. Let's say it's gold. They see the exact same setup on the chart. They have the exact same idea. They both think gold is going to go up.
So same information, same hypothesis, same market context. The playing field is level.
Right, but they behave very differently. Trader A, will call him the gambler. He wants to win big and he wants to win now. He sees the potential reward and gets really excited, so he bets the farm. He risks a huge portion of his capital on this one trade, maybe 20% or even 30% of his entire account.
He's chasing the high. He's prioritizing the reward over the risk. He's thinking about the Ferrari he's going to buy, not the potential crash that might happen first.
Exactly. Then there is Trader B, the professional. She likes the trade. She also thinks gold is going up, but she respects the uncertainty. She knows she could easily be wrong, so she risks a small, controlled, predefined portion of her capital, maybe 1% or 2%.
She is prioritizing survival. She is thinking about defense first, offense second.
Now, here is where it gets interesting. The market eventually does go up. They were both right about the ultimate direction. But before it went up, it dipped. It got volatile. It shook people out.
which markets almost always do. They rarely go in a straight line from A to B. They breathe, they fluctuate, they test your conviction.
Exactly. So the price drops 5% before rockets up 20%?
Yeah.
What happens to trader A, the gambler?
The dip completely wipes him out. Because he bet so much, a standard 5% move against him caused catastrophic damage to his account. He either panicked and sold at the bottom, or he got a margin call, which is when the broker forcibly closes your position because you can't cover the losses. He is out of the game before the prediction could even come true.
So he was right about the destination, but totally wrong about the journey.
Correct. He failed to survive the volatility. He was right, but he went broke being right, which is a terrible place to be.
And what about trader B, the professional?
She took a small hit on paper during that dip. Because she only risked 1%, the volatility was uncomfortable perhaps, but it wasn't fatal. Her position size was small enough to withstand the noise. She survived the shakeout, stayed in the trade, and eventually rode the wave up to profit.
So even though they both had the same prediction, only one of them actually made money.
Because only one survived what the source calls the long series of mistakes, or just the natural chaos of the market. And this is the deep dive takeaway. Time is the filter. Trading looks very, very different when you introduce the element of time.
It's not about the snapshot of, am I right now? It's about, can I stay in this game for the next 10 years?
Correct. It is not about how much you make when things go right. It is about how little you lose when things go wrong. And here is a piece of math that usually shocks people when they first hear it. If you lose 50% of your money, you need to make 100% just to get back to even.
Whoa, say that again. That math is brutal.
It is. If you have $100 and you lose 50%, you now have $50. To get back to your original $100, you have to make $50 profit. Well, $50 is 100% of your current account. The hole gets deeper much faster than you can climb out.
That makes the damage control philosophy make so much more sense. You can dig yourself a hole you just can't climb out of.
And that is why professionals are obsessed with defense, while amateurs are obsessed with offense. Professionals know that if they protect the downside, the upside will take care of itself eventually.
That is such a crucial distinction. Amateurs play offense, professionals play defense.
It changes everything about how you interact with the market. Once you truly internalize that, trading stops feeling like gambling, which is just an emotional roller coaster of highs and lows, and it starts behaving like a structured process.
Which leads us perfectly to the psychology of structure. The source talks about moving to an advanced level where you treat trading not as a hobby or a trip to the casino, but as a business.
Yes, this is the mindset shift that separates the long-term winners from the losers. Think about a standard retail business, a clothing store on Main Street. Does the owner of that clothing store fry when they have to pay rent every month?
No, of course not. It's just a bill. It's expected. It's a cost of doing business.
Do they have a mental breakdown when a shirt gets damaged or stolen?
I mean, they probably don't love it, but it's shrinkage. It's part of the overhead. You budget for it.
Exactly. In trading, losses are your inventory shrinkage. They are your cost of goods sold. There are overhead costs in this business, and they are losing periods, execution costs, and the emotional pressure of maintaining discipline.
So you have to budget for the losses. You have to expect them, just like a coffee shop owner expects to have to buy coffee beans. They're not a surprise.
Without accepting these realities as part of the process, rather than viewing them as personal failures, consistency is impossible. If you take every single loss as a sign that you are stupid or that the market hates you, you will burn out. You will emotionally bankrupt yourself. But if you view it as paying the rent, you can stay rational and keep going.
I want to ask about the behavioral changes.
Yeah.
The source says that when you truly accept this architecture of probability, your actual behavior changes. You don't just think differently, you act differently. What does that look like in practice?
Well, the biggest and most profound shift is that FOMO, the fear of missing out, it just disappears.
That's a big claim. FOMO is a powerful human emotion. It drives crypto bubbles, housing bubbles. I mean, it drives everything.
It is powerful, I agree, but FOMO comes from a scarcity mindset. It comes from thinking, I have to catch this move because I don't know when the next one is coming. When you understand probability, you know there will always be another bus coming. There's another opportunity tomorrow and the next day. So you stop forcing opportunities where none exist.
You stop chasing the market. You stop feeling like you have to be in every single trade you see.
And here's the paradox that surprises people. You actually trade less.
Really? I would have thought you'd trade more, to get the law of large numbers working for you.
You need a large sample size eventually, yes. but day to day. You trade less, but with much more intention. You become a sniper, waiting for the perfect alignment of conditions, rather than a soldier running out into an open field, just spraying bullets and hoping to hit something.
That's the aha moment for me right there. It's the difference between activity and productivity. Just because you're clicking buttons doesn't mean you're trading well.
In fact, often the more you click, the worse you are doing. Overtrading is a classic sign of a gambler's mindset. The structural mindset is patient. It waits for the odds to be heavily in its favor before risking capital. It waits for what baseball players call the fat pitch.
This brings us to the final section of the source material, which is titled Clarity Before Profitability.
The hierarchy of success.
Right. And the source warns against shortcuts. It seems like the internet is just full of people promising 1,000% returns in a week, or this secret robot will make you rich.
And those promises are so attractive because they bypass the hard work of understanding. They sell the dream of the roof without any of the work of building the foundation. But the goal of this deep dive and the goal of the source is clarity.
Why does clarity have to come first, though? Can't I just get lucky and make money first and then figure it out later?
You can. That's called winning the lottery. But what happens to most lottery winners who don't understand money management?
We read about them all the time. They usually lose it all within a few years. Bankruptcy, total ruin.
Exactly. You cannot be sustainably profitable in a game you do not fundamentally understand. If you make money without knowing why or how you made it, you will inevitably give it back. The market has a way of reclaiming money from people who haven't earned the discipline to keep it. Clarity is the safety net. Clarity is what keeps you from losing it all when your luck finally runs out.
The source talks about alignment. That success comes from aligning your actions with the reality of uncertainty, not trying to fight it.
And it goes right back to our foundation analogy. If you treat trading as a game of prediction, you are fighting reality. You are fighting the fact that the future is unknowable. That is a fight you will always lose. The market is bigger than you are.
But if you treat it as risk management,
Then you are aligned with reality. You are saying, I don't know what will happen next, but I know how I will handle it if it does. That is a foundation that can hold weight. That is a structure that can survive an earthquake.
I love that visualization. It really does change how you look at the charts. Instead of asking, what is the market going to do, which is an impossible question,
Yeah.
you asked, what am I going to do if the market does X, Y, or Z?
Precisely. You shift the focus from the external, which you can't control, to the internal, which you can. You control your entry point, you control your stop loss, you control your position size, and you control your emotions. That is it. That is the entirety of your control. Everything else is just weather.
So as we wrap up this deep dive, let's recap the main pillars of this architecture. If our listener wants to walk away with a clear blueprint, what is it?
Okay, let's look at the blueprint one last time. First, trading is not about money. It is decision-making under uncertainty. Second, the goal is not prediction. It is probability management. Third, trading is a process, not a single event. One trade proves absolutely nothing. 1,000 trades will reveal your edge.
And fourth, the big one.
Survival depends on keeping losses small. It is not about being right 100% of the time. It is about damage control when you are inevitably wrong.
It's such a powerful reframing. And honestly, it makes the whole thing feel a lot less intimidating. It takes the magic out of it, the wizardry, and replaces it with math and discipline.
Which is exactly what you want. You don't want magic with your money. You want structure.
Before we go, I want to leave our listeners with a provocative thought, something the source hinted at. We talk about how we are all traders in life, trading our time, our effort, our emotion.
Yes.
Well, if trading is just exchanging something you have for something you expect to be more valuable, where else in your life are you currently trading poorly?
That is the question, isn't it?
Are you risking too much time on a relationship that has no future value? Are you holding on to a losing position there? Are you investing too much emotional energy into a job that is giving you zero return on that investment? Are you trying to predict the outcome of a risky personal decision instead of just managing the potential downside?
Are you holding on to a losing position in your life, just hoping it will turn around, instead of cutting your losses and freeing up that capital, your time, and your energy for a better opportunity? That is the ultimate application of all this.
Oof, that hits home. It turns out being a good trader might just make you better at life.
That is the ultimate goal. Build the foundation first. Clarity always, always comes first.
That's it for today's deep dive. We hope this gave you a new lens to look at not just the markets, but your decisions. Thanks for listening.
See you on the next one.
If this video added clarity to how you see trading, support this work. An interaction tells the algorithm this foundation matters. A subscription tells me to keep building it with you.